Hi, and welcome to Janken's Code on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to talk about how to think about foreign exchange forward rates. Now, these forward rates are, one of the mysteries of life. We can never seem to quite wrap our heads around them for long, at least. I mean, it might seem clear on one day, but then the next day we're back in doubt. So it's elusive, how does it work? How are these rates determined? But in this video, we're going to sort that out once and for all. So there's plenty more on forward rates in my book, Corporate Foreign Exchange Risk Management, co-authored with Lars Uxelheim and Alf Alviniussen. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. All right, so what do they do, these foreign exchange forward contracts? Well, they allow you to lock in a certain forward exchange rate. That is basically letting you know beforehand the rate at which you're going to be able to convert foreign currency cash flow at a certain point in time in the future. So you don't have to live with the uncertainty that comes from being exposed to an uncertain spot rate. Because if you're not hedged, you're going to, your fortunes are going to fluctuate with the exchange rate. You don't know what you're going to get in home currency day until the day arrives when your transaction takes place. So you can pretty much eliminate the entire exchange rate uncertainty in a transaction if you enter one of these contracts and you hedge your entire exposure. So that is what they let you do. But where do they come from then? How are they determined? What are the principles that allow us to work out, what the forward exchange rate should be at any given point in time? So that's what we're here to try to answer. So we're going to start with this basic or fundamental observation that we're dealing with derivatives. A forward contract is a derivative. And the thing about derivatives is that they derive their value from some underlying price or rate, the underlying, as it's referred to. That could be an exchange rate or a stock price, but a whole lot of other things as well, because there's an almost unimaginable creativity in these markets. So you can write contract with respect to almost any variable now these days. So derivatives are priced typically according to the no arbitrage principle. This is the principle that holds up or underpins derivative markets. That gives us a set of principles according to which we can price these things. And arbitrage means, there's risk-free profit. You can make a gain without taking any risk. You're guaranteed a certain profit, but you're not exposed to any risk. That's arbitrage, and it's not supposed to exist in these financial markets because they're efficient. People have lots of information and lots of knowledge about how things work, and they're going to detect if something is promising that kind of opportunity, and they will immediately get priced away before it can materialize into something, economically meaningful that anyone can get rich on. So arbitrage is supposed to get competed away, basically, in financial markets, preventing risk-free gains. So what you do then to implement this principle for the sake of pricing a derivative is that you put together a combination of traded assets that are traded in the market, so they have a quoted price and we can observe their values, right? And the trick is to do this in such a way that the payoffs from this portfolio that you've just created mimics the derivative. It has the same sort of payoff structure that your derivative has in all scenarios. So it's identical for all intents and purposes here. And then we know, because we can just look at what this portfolio is trading for. Like what's anything, an asset or a portfolio of assets with these characteristics, this payoff structure and this risk, what's it trading for? We know that because we have this replicating portfolio now of traded assets. And we can infer that because the payoff is the same and the risk is the same, it behaves in exactly the same way across these scenarios, well, the price has to be the same. Otherwise, you could create, arbitrage situations. And so that's a general idea. We put together these replicating portfolios of traded assets that behave exactly like the derivative, and then we can just derive the price from that portfolio. All right, so moving on here more specifically then to forward rates in the foreign exchange market. They are functions of interest rate differentials that we can establish with some confidence, at least in the more efficient markets where there's actual trading and not one of these exotic currencies where it's more of a negotiation and supply and demand in that particular corner of the world. But it's going to be about interest rate differentials, and the forward rate essentially takes the spot rate as the starting point, and it adds an interest rate differential. So that will explain the forward rate, essentially, what the difference in the interest rate is in the two countries concerned, or the two currency regimes concerned. And here we need some terminology, and this is also something we often find hard to make it stick. We try to learn it, but it sort of escapes our memory nonetheless. But here we go. The spot rate then is quoted as units of quoted currency per unit of base currency. So one of the currencies in this pair is going to be quoted currency, and the other the base currency. And in this particular pair here, the US dollar versus the Swedish krona, here we would refer to the Swedish krona as the quoted currency in the denominator. The US dollar here in the numerator is the base currency. That's the most typical terminology in the market. So whenever this exchange rate is 9, for example, it means that it takes 9 Swedish krona to buy 1 US dollar. All right. And now let's assume something about the interest rates in these two countries. Well, let's say the US interest rate is 3% and the Swedish rate is 2%, annualized numbers. Okay. Obviously, the interest rate differential is going to be 1%. Easy so far. But then we run into our problem, right? That how are we going to determine which way it goes, even if we manage to grasp, or stay attuned to the fact that we have a base currency and a quoted currency. That's that's tricky enough. I mean, don't feel bad about that. You're not alone. We all struggle with that. But even if we have that in place, what now is it going to? In which way is it going to move the exchange rate? If we know that this interest rate differential is 1%, and we know that this is going to determine the change. All right. Well, here's the key to get this right. We have to make it so that the currency with the higher interest rate weakens. All right. So if a country has a higher interest rate, that's the currency that has to get weaker over the lifespan of this forward contract. And we're going to investigate why this is so. Well, look at it this way. If you're getting both the higher interest rate and a stronger currency, that would be too good. Everybody would rush there, and the whole thing would be, it wouldn't really be realistic. It would be somebody's giving money away, apparently, like if you could lock in forward rates under these conditions. So here's what goes, rather. The forward rate must compensate. The way we set it, it has to end up so that whoever invests in the low interest rate country is compensated for the fact that there's a lower interest rate there. Otherwise, everybody would switch and lock in the forward rate and collect these gains. And that can't happen, because we're going to assume efficient financial markets here that they don't let that happen. So since we've assumed a stronger or a higher US interest rate, that must mean then that the dollar is going to get weaker over this time period. So we try that, and we derive the forward rate as in the following way, where we scale it up. Here's a spot rate, and then we scale it up by the quoted currency interest rate. That's the Swedish krona interest rate, right? And we scale it down by the base currency interest rate, the one we get in the US. The net effect of that will be a weaker dollar, because it now only takes 8.9 something Swedish krona to buy $1. So implying a weaker dollar then, which is what we intended. So this is consistent with the idea that the country with the higher interest rate needs to see its currency weaken. This is we managed to obtain that here. All right, so let's try instead a different forward rate. Let's say it had also been, if it also were 9, how would things look? So the spot rate is 9, but the forward rate is also 9. Yeah, well, then we can actually set up trading strategies to create gains at zero risk, which we're ruling out here. It's not going to be, assumed. So we're going to use a small example here to show you how that happens. So let's say that is the case then. And you go to the bank and you borrow 9 million Swedish krona, and you are required to pay a 2% interest on that. You can then convert that at the present or the current spot rate, giving you 1 million US dollars. At the same time, same day, you sell forward 1,030,000 US dollars. So you're committed to sell that number of dollars 1 year from now, and you lock in the forward rate effectively of 9, because we're in this example we're assuming it's 9, right? In the meantime, you have the money placed in US bonds, earning you a 3% return. So then at the end of the year, you have 1,030,000 US dollars, considering the interest you're earning, right? So which is exactly what you had sold forward. So you have the dollars you need, that you've committed to selling. You have them now, and you can, sell those. And since you've locked in 9, then as per the forward contract, what you're going to get is 9,270,000 Swedish kronor. All right. Well, we still owe the bank in Sweden where we borrowed the money, right? So we have to pay them, and they are, going to get a 2% interest on the borrowed money, right? According to the loan agreement. So we have to hand them over 9,180,000. Now, this is less than what we have, so we can pocket that. We have managed to earn 9.2 something, but we're paying back 9.1 million something, and pocketing 90,000 krona in a risk-free gain. Right? There's no risk involved here. We're guaranteed to get this surplus, right? No risk, but a gain for sure. So this is not how the financial markets really are supposed to work. If you find that it does, well, then you have my congratulations, that's a good day for you, but it's normally not going to happen. So let's try it instead with the forward rate that we calculate. So we borrowed to at 2% in Sweden, with the bank in Sweden. Immediately convert that to dollars, same as before. The spot rate is still 9, right? We haven't changed that. So, and we try again this strategy of selling $1,030,000 forward, but this time we don't get 9. We get the calculated forward rate of 8.9. So we still try the strategy of investing at 3% in use bonds, right? So giving us, as before, 1,030,000 US dollars at year end, which is what we've sold forward. So we do that. We convert it at that rate. This time, though, it only gets us 9,180,000 krona. All right, so we have to pay back the bank. We do so. We owe them 2% on the loan. So that turns out to be 9,180,000 kronor, which is now exactly the same. So we're breaking even. So it's a fair sort of deal. There's no profit nor loss, and there's no arbitrage involved. There's no risk-free gain. So this is how it's supposed to work. So now you can see why this calculation of the forward rate turns out to be the way it is. That's where it comes from, to prevent arbitrage and to make sure that this number is ultimately zero. All right, so some conclusions. Forward rates in FX markets depend on interest rate differentials. Other outcomes are ruled out because they would violate the non-arbitrage principle, which is the very foundation of derivative pricing in these so-called efficient markets. And to get it right, we have to always remember that the currency of the high interest rate has to see its currency weaken. And that is because that way the investment opportunities are equalized in these two currency regimes. It doesn't matter if you invest in one or the other. They are supposed to come out equal. Now that's the theory of it. Yeah, you can always chase for temporary deviations from these principles, but this is basically the core of the argument, and helps you understand why exchange rates for foreign exchange forward rates appear the way they do. All right, here's my two books. You please check them out. There's also more information on riskbudgeting.se, and please like and subscribe. Thank you and have a good day.